Hello, everyone. Welcome back to Risk. Today, I have a returning guest, Mr. Michael Pento. Welcome back, Michael. You were here not long ago, and you made a really just the perfect call. You said that things were going to start declining in the first quarter of this year, and they certainly have. Has your view changed since that point?
Well, first, thanks for having me back. Always good to be with you, Lee. Yeah, I mean, if my view has changed, it's probably gotten a little more dire.
Oh boy.
I mean, I don't understand for the life of me why I keep hearing on the mainstream financial media how great earnings are going to be this year. I don't understand what in the world are they looking at? I mean, you might have an increase in nominal terms earnings, but what those earnings are going to buy will be so real earnings are going to crash. Let's just get that out of the way. The rate of change, real earnings crash for sure, and the purchasing power of those earnings are going to crash even further. You have a fiscal cliff, a monetary cliff of record proportions. You have the problems going on in Russia, which is exacerbating the inflation and creating more bottlenecks. Have we heard the last of the shadow banking system confessions of what they owned of Russian assets that they couldn't sell in time and are now bankrupt? I mean, how many long-term capital managements are there out there?
Yeah.
I don't know, probably more than one. But I don't know. I'm just guessing. If you owned a significant amount of Russian assets prior to February, and now you have those assets are worth zero, who's taking those losses?
That's a good point. I just spoke with Mark Faber last week, and he brought up long-term capital management as well, and he said basically that ushered in the era of complete just go for it, don't worry, complete moral hazard on Wall Street. Would you agree?
I mean, 1987 started it off for me, but I mean,
okay.
We're quibble with stupidity. I mean, the stupidity got worse and worse. 87, then brought in long-term capital, then the year 2000, then 2008, then 2018, then 2019, then 2020, and here we are in 2022, where they actually have no choice but to act tough. You know, inflation is now 8.5%, as I'm sure you're aware. 8.5%, the way they measure it.
Right.
You measure it in reality, it's the highest rate of inflation we've ever seen by a lot, Lee. Housing, beef costs, energy prices, they're all up miraculously the same amount. The number is 20%, not 8.5%. Trim, mean, don't eat meat, eat grass, hedonically adjusted, substitutionalized adjusted crap. It's 20%. And so the Fed has to do something. It's, if you want to measure it accurately, 10 times higher than their asinine inflation target. But the way they measure it, it's more than 4 times their inane inflation target. So they have no choice. This is the most hawkish Fed, at least as we're promised, the most hawkish Fed since Paul Volcker by a lot.
Now, and they made a micro adjustment to the rates, and we've got an inverted yield curve, right?
We have an inverted yield curve. Yield curve inverted. Here's what you want to know about the inverted yield curve. I wrote a whole piece about it. The yield curve inverted after just one lousy, measly 25 basis point rate hike. That's how weak the economy is. It normally takes 300 basis points to invert the yield curve, at least. So it happened every other time. Now it's 25 basis points. And yield curves inverts. And then you're usually only allowed 100 basis points after that. And then the Fed says, oh no, I'm done. But now they can't say that because they'll do 100 basis points between May and June. And then guess what? We can't be done because you'll have a 1.5%, 1.25%, 1.5% Fed funds rate, but inflation is still going to be 8.5%, or maybe comes down to 7.5%. But you still have a huge inflation problem that you just can't ignore. The Fed can't. This is when the Fed's going to stop hiking rates. When the rate of inflation goes down below 4%, or the stock market goes into free fall and the credit markets freeze. Either one, it could be both, but one of those things will happen first. I think that the stock market and credit markets will freeze long before the Fed gets inflation down to 4%.
So if the market crashes, like you suggest, and
I hate to interrupt, but sometimes I have a nasty habit of doing that. First of all, the market already crashed.
Right.
I mean, in early January, half of the NASDAQ stocks were down 50% or more. So the market already crashed. If you own bonds, you're down 16%. If you go out on duration bonds, long-term bonds. You own the NASDAQ Qs, you're down what? I think I wrote it down. I think I have a senior moment. QQQ's down 14%, S&P's down 7%. So you're down. It's already crashed. I mean, it depends on,
But I mean, it sounds like you're suggesting worse.
Did I say again?
I said it sounds like you're suggesting worse ahead.
Oh, I think it's going to get much worse ahead. Okay. We have, like I said, the most hawkish central bank ever on the planet.
Well, you had suggested that the market has much further to go. I mean,
well, they haven't even started yet, Lee.
Right.
The Fed raised rates by 25 basis points, and they haven't drained one penny from their $9 trillion balance sheet. So growth is slowing rapidly on a global basis. We've seen the peak of inflation, although albeit only going to come down on a rate of change basis, maybe 100 basis points, 200 basis points. Still going to be way higher than the Fed's target rate. And now the Fed has promised 50 basis point rate hikes and the most daunting quantitative tightening experiment ever. 2 times greater than the one they did before. The only other one, they tried to unwind the balance sheet. They got about 500 billion out, and then the market cratered and the credit markets rose. This time they're going to be doing $1 trillion a year. Let me see if that's going to work. So they're going to try it. They're going to fail. Markets are going to crash. Asset prices are going to plunge. And then we'll see what they do. The Fed put, I'll tell you this, the Fed put is much lower than anybody really feels on Wall Street. I keep on hearing, the Fed's going to come in. The Fed is not going to come in because they're trying to get Democrats elected in the midterm elections. And the Democrats are not going to get elected if inflation is at 8.5%, the way the government records it. It's not going to happen.
Are they going to get elected if the market crashes much further than it is now?
So the calculation is, let's see, more people who own stocks are Republicans than Democrats. So I'll sacrifice the stock market so I can get the Democrats to hold power in Congress. The members of the FOMC are mostly liberals, and in my opinion, and who controls the White House right now, and who nominates people to the FOMC? It's the president. Okay, so that's my predicate. I'm not backing away from it. And even though it might not be true, even if and by the way, I'm a libertarian. I hate both parties. I hate Republicans, and I abhor Democrats. So I'm politically unbiased. It's the right thing to do. I mean, what's their choice, Lee? Here's the calculation. I could raise rates 25 basis points, get worried that the stock market isn't going up in the first. We had a whole quarter where it was down. Okay. Let's not drain the balance sheet at all, and let's not raise rates anymore. What do you think is going to happen when the 10-year note goes to 15%, double digits? Because that's where it'll go, and mortgage rates go to double digits. What do you think is going to happen to asset prices anyway? And then you have 2 problems on your hand. You have asset prices to crater because there is no alternative. There's a great alternative, and it's called sovereign debt at double digits. I'd probably put if you can offer me 12% on a 10-year note
you're there, no doubt.
I'd sell every damn thing I own and more. And you know what? Or they let that happen, and then they have the market crash. Oh, by the way, they have a really bad inflation problem that's much worse than they have now. Or they can crash the market and not have an inflation problem. What do you think they're going to do?
Right. Yeah. I mean, the inflation problem is just hitting everyone, and it hits the lower classes the most. I mean, it's the biggest percentage of their earnings. So, I mean, especially when they go to the gas pump or the supermarket. So as to that, I know you're calling for like a deacceleration of inflation in the near future.
Disinflation.
Disinflation. Okay, so in that scenario, I could see equities, I could see the real estate market deflating, but what about everyday things like commodity-driven things like food and energy?
Well, I think commodities would well, hopefully oil prices would go down a little bit, but not much. I mean, I don't think they're going to go down much at all, to be honest with you. If you look at used car prices, they might have peaked. If the Fed crashes is able to at least bring home prices into a more tractable scenario, where they're not rising 20%, they're rising at maybe 10% a year. I think at the very minimum, they're going to be able to do that. I think home prices are going down 20% year over year this time next year. So 40% of the CPI is owner's equivalent rent. So, yeah, inflation is going to be lower, but the process of getting it lower, first of all, it's going to be more arduous because you have China, supply chain bottlenecks, close down Shenzhen, close down Shanghai. I mean, how is that good for growth or inflation? Lower growth, higher inflation. Russia and the war in Ukraine. I mean, you know what the price of wheat is going to be next year? I mean, it's not coming down. It might. So the rate of change might be, lower, but it's not going to go negative. I don't think we're going to have a negative CPI print. The only reason why I would have a negative CPI print is if we have a deflationary depression, which, by the way, is what we really need. I mean, I hate to say this, Lee, but what we really need is we don't need the stock market to be 185% of GDP as it is today. It hit 210% at its all-time record high in January. The stock market cap relative to the underlying economy should be closer to 50%, not 200% of the economy. So we need that. And what about this, Lee? How about you priced out of home ownership? First-time home buyers are priced out of the market. What about that? So, especially where I live down here in Naples, Florida, I have a house in Naples. It's ridiculous. The prices here are absolutely, even real estate agents who have been in the business for like decades go, their mouths agog. They're like, oh my gosh, you kidding me? You paid that much for that?
Right.
So, home prices, the house one of the houses I was looking at is up over 100% in the last 2 years.
That's insane. That really is insane.
So they have to get inflation under control. They're going to do that. They will sacrifice the stock market, is my opinion.
But what about oil? You just mentioned it, but Biden just released a bunch of oil into the market using the strategic reserve. When that dries up, what happens?
Well, it's the worst thing you could do. It's almost like wage and price controls. I mean, do they work? So you're telling people you're going to use. First of all, what is the purpose of the SPR? I thought it was for an emergency where there's a war going on and we don't have access to Russian oil or any oil from Saudi Arabia, Middle East, maybe Venezuela cuts us off, World War III, whatever. And we now need this to heat our homes at the drum. So it's there. So we figure things out. I didn't think it was there to control prices. Did you, Lee?
No.
But this is what we have now. So we have an administration who says, okay, I don't like the price of oil. I have to get real, I need my Democrats to maintain Congress, the House and the Senate. So what I will do is I'll release the cushion that I have. So when you use up that cushion, people say, oh, gee, you haven't solved the intrinsic issue and you've spent your savings. So the problem gets even worse, not better. That's what I think. That's what I think about the stupidity of tapping the SPR. I think it's a temporary salve that doesn't last long. Now, I'll tell you what is a more enduring salve is to crush demand. So Biden might have gotten lucky with his SPR release, but that is not why oil prices have retreated from 120 to sub 100. It's because demand is cratering across the globe, and it's going to get a lot worse. The Federal Reserve is not the only central bank that's involved in this massive monetary tightening. Almost every other one on the planet is, other than Japan, which is a retirement.
They've been a mess since '87, right?
It's a retirement home train wreck. I mean, the people in charge there, not the citizens. I don't ever attack people. Chinese people are great. Japanese people are wonderful. Europeans, I love them. I'm one of them. Ancestrally. It's just the people in charge. It's ridiculous. They have this guy Kuroda in charge over there who's like, I don't care if my currency goes to zero, I'm going to buy every single bond that is ever been issued, that ever will be issued, to make sure interest rates stay at zero going out 10 years on a JGB. I mean, what world do you live in? How you can't be proud of yourself when you destroy markets to that extent, and you think you can do it with impunity. You have to be exceptionally arrogant and exceptionally stupid.
Well, I mean, just the arrogance of all these bankers. I mean, they're central planners. I mean, throughout history, we've seen central planning fail time and time and time again, and they keep justifying themselves.
Yeah, but central planning down around the fringes. I mean, this is central planning where you've usurped and vanquished and eviscerated any vestiges of the free market. There's not much free market left anymore.
Yeah.
Especially when you talk about the Japanese bond market. But what's the free market in interest rates? Interest rate repression. I mean, you think the yields in Italy are justifiable where they are? The 10-year note in Italy. You have pretty much an insolvent country with borrowing money at 2% or thereabouts. So a German Bund, it's ridiculous. It's just, it's even today with the 10-year note around 2.77%, 2.8% on the US 10-year note. It's ridiculous. If you had the last time inflation was 8.5% was in 1981. You want to know what the 10-year note was back then? Then take a look, take a chart, and we're way into the double digits, and now we're at a 2 handle. 2. Oh, by the way, in 1980, the debt to GDP was much lower than it is today. If you look at total non-financial debt, we're at $60-something trillion. I think we're at total non-financial $65 trillion. Total non-financial, 270% of GDP.
I can only imagine what the percentage of the stock market was to the GDP. It had to be tiny.
You don't have to, I have this stuff in my head. So
Okay.
ask me the year and I'll tell you.
God, tell me.
Well, tell me. Ask me the year. 1980 was about 45 to 50%.
Okay.
TM, total market cap to GDP.
Which is where it should be. I mean, do you foresee a Volcker coming out and drastically?
Paul Volcker is God rest his soul. He's not coming anywhere. But do you see Paul Volcker coming out and Jerome Powell? Yes, I do. Until he realizes that the asset prices have become such an integral part of the economy that you can't crash them and not crash the economy as a concomitant consequence.
I mean, are you foreseeing breadlines and Great Depression or worse? Or
well, I mean, I don't want to be hyperbolic here. I mean, I predict the burst. I am predicting probably the worst bear market. The odds are high that we'll have the worst bear market in history coming up. Worst bear market in history. Now, here's the thing. The Fed put is way below where anybody else could ever imagine it could be because of that inflation rate. And I want to make sure I make this point clear. If the Fed says, like they did every other time, okay, let's stop QT, let's stop raising interest rates, and everything will be okay. Not when you have inflation at 8%. It just doesn't work that way. You have lost the luxury of doing that. When inflation is below 2% and you turn from being hawkish to dovish, not a problem. When inflation is at 20%, which is where it really is, and the middle class is ready to go, into the streets. You look what's going on around the world. You know how many riots there are around the world because of food prices?
Yep. And it'll come here too.
Well, it could come here. I don't want, again, I'm not predicting it. I don't want it to happen. But imagine if the Fed says, Wall Street is down on the year, and I am going to protect Wall Street. This is Jerome Powell. I'm going to protect Wall Street, even though you can't afford to feed your family. 40% of Americans have $1,000 in savings or less. They have no stock market. They rent. What are you telling those people? So you're going to have a big problem no matter, in other words, what I'm telling you, no matter what the Fed does, they have a huge problem on their hand. And I think the Fed would rather have a deflationary recession / depression short term than having a long-term stagflation problem, which is going to crater the market anyway and create that depression anyway, and then end up with inflation running out of, becoming hyper.
Is there anything you want to tell the audience? I mean, why don't you reiterate your four horsemen again as to where they should be putting assets? And
so, listen, I'm not in the four horsemen right now. I have parts of the four horsemen. Right now. But the four horsemen, you have to jump on the four horsemen of the apocalypse, economic apocalypse, probably sometime later this year when the credit markets completely freeze over. And that means, all that means is that everything goes to a correlation of one. I don't care if you own Microsoft or Apple. Apple's the nifty 50. You have to own Apple. Apple can never go down. BS. Apple is a stock part of every ETF on the planet. When people sell their ETFs to get out of the market, Apple is part of the ETF, and they'll have to sell Apple stock. I don't care how good the iPhone 17 is. Nobody gives it a hoot, okay? So, cash, everybody wants cash. Everything goes to a correlation of one. R squareds go to one. Everything is the same. You have only four things you can own: cash, sovereign US debt, the US dollar, and short the market. Four things. That won't last forever. It won't last. I mean, you're going to have to eventually get out of that. Not eventually, sooner rather than later, depending on how fast that central banks start to reliquify the system. But then you want to go from the four horsemen, which is deflation and depression, to stagflation. Probably move very quickly along that spectrum that I created. But as I said, you'll not fix the economy. You're only going to render it economically lame, but also have stagflation like we've never seen before.
Doesn't look very rosy ahead of us.
I mean, did you expect anything differently? I mean,
Obviously not. Yeah.
You can't. You just can't tell markets that they don't matter forever. I mean, you take interest rates down to 0%, leave them there for the better part of 2 decades. Okay, let's be honest, right? Better part of 2 decades, they've been close to 0, 1% from 2003, and then 2003, 2005. Then you raise them for a little while, then you're back to 0 in 2008. Then you remain pretty much at 0 until 2018. Then you go to 2.5%. Then you're back to 0 till 2022. And then you say, well, what happens when you do that? Well, you push people way out on the risk curve. What do they own? They own 5 houses that are, at record prices with the minimum amount down. I mean, it's not as bad as it was in 2007. You have to have something. You have to have something down. But if you own 5 houses that are not rented out because your renters are unemployed and they're no longer going up in principal, what do you think you're going to do? What's the calculation? I own 5 houses, they're no longer going up, and my renter stinks. I can't get rid of them. I'm going to sell these as fast as I possibly can because nobody can live. There's not one individual on the planet that can live in more than 1 house at a time. You don't need 5 houses, but everybody owns multiple houses. You would be surprised. Here, you won't be surprised. I'll give you a statistic. In the Sun Belt, 1 out of every 4 houses is investor owned. Thank you, Blackstone. So that's a lot of, 20, 25% of homes could go on the market because their principal is no longer going up. No, I'm not very ebullient about the market.
Is there anything else you'd like to say to the audience before we sign off? Your 60-40 portfolio isn't working. You still have some time left to get on board an active money manager who knows what the heck they're doing, has an algorithm, a model that can get you in and out of not just the stock market. What do you own? When do you want to own bonds? When do you want to be short bonds? What kind of bonds do you want to own and what kind of bonds do you want to be short?
For me, I want to own treasuries now because I think we've reached the peak of inflation and growth's about to crash. And you want to be short junk bonds. It's that kind of, when do you want to own gold? When do you want to get out of gold? Do you want to own bond and bond proxies like utilities? We have been, especially in bond proxies. Or do you want to be short those things and out of those things? So it's just about, trying to be intelligent about this, the macroeconomic sector, the rate of change of those conditions of inflation and growth, and trying your best to invest accordingly. Because if you're just in this 60-40 portfolio, like I said, duration's down 16%, Qs are down double digits, and the S&P's down 7. So good luck. And it's just beginning, Lee. Just beginning.
I would like to recommend to the audience to find our prior discussion on this channel and watch it, and you'll see how accurate Michael was in his calls.
Thank you so much, Lee. I'm not perfect. I make a lot of mistakes. I get a lot more things right than I get wrong, and that's the key to making money. And you also have to try. I'm not a used carpet salesman. Most people on Wall Street just take your money and put it in. Okay, let's own some bonds, U.S. bonds, some corporate bonds, sovereign bonds, corporate bonds, some big cap stocks, some small cap stocks, maybe some foreign stocks. Or maybe we'll throw in a couple of, maybe oil or some kind of small commodity, and that's it. Go.
It's formulaic down on Wall Street, isn't it? And it has been for 40 years. And I think that formula is about to really fail for everyone.
It doesn't work. I mean, ask the people in Japan in 1989 how well that worked.
Yep.
Or the people in China in 2007, how well that worked. They're still not anywhere close to being even in nominal terms after decades.
Well, Michael, I really appreciate your time. It's great to have you back, and have a great week, and we'll talk to you soon.
Happy Easter. God bless.
You too, Michael.